This weekend, we witnessed the biggest liquidation event in crypto history. Over $19 billion wiped out in the blink of an eye. That's almost 10 times larger than the COVID and FTX crashes. And it's left everyone asking the same question. Was this just leverage catching up to greed, or something more sinister, an orchestrated attack of insider trading? The damage is simply insane to think about. Nearly $1 trillion in market cap erased. That's $100 billion per hour for 8 hours straight. Major exchanges like Binance face system freezes and liquidation waves, prompting accusations of manipulation, even from other exchange CEOs. And yes, 1.6 million traders were liquidated. But somehow, one whale who started shorting right before the crash made $200 million. So today we're investigating what really happened, the insider trading and manipulation calls, and whether or not this is really ending the bull run for retail investors. Let's start with what we know. According to CoinGlass, over $19 billion in crypto positions were liquidated in under 12 hours. $10 billion on Hyperliquid, $4.5 billion on Bybit, and $2.5 billion on Binance. While the real damage is estimated to be as high as $30 to $40 billion, we saw that DEXs weren't safe by any means either, because on Solana alone, $400 million in on-chain positions were wiped out. Overall, we're looking at the single largest liquidation event in crypto history, with over $19 billion worth of leveraged crypto positions gone in just 24 short hours. That's over 9 times bigger than the previous record. So was it manipulation? Well, once the shorts hit, chaos followed. Altcoins collapsed and some went down by over 90% in mere minutes. We saw alts like Cosmos briefly trading at $0.001 on Binance, giving one buyer a $285,000 profit on a tiny $100 order. Now here's a really important note from Shaw about the cause of this cascade. He says this crash exposed how thin SEX order books really are, and how just a handful of players actually control the real order flow. They literally wiped the entire order book on some of these coins. Atom went from $4 to $0.001. Sui went from $3.4 to 56 cents. Link went from $22 to $8, and ADA went from $0.8 to $0.3. Overall, the top 100 blue chips nuked by about 75 to 80% in a few minutes. Meanwhile, Zcash was the only green candle, up about 9% during the meltdown, and it refused to give up its annual gains. While this was happening, even the Crypto.com CEO called for an investigation into the practices by Binance, which left so many accounts blown up. Bein Crypto also reported that hundreds of Binance users either missed trades or they couldn't withdraw their funds during the crash, with a flood of market manipulation accusations against Binance, which of course only deepens distrust in centralized exchanges. For traders though, things got extra nasty for anyone using USDE as collateral in their unified trading accounts. Because once USDE got depegged, they got absolutely wrecked by automatic deleveraging, or ADL, which apparently most traders are unfamiliar with. Although the USDE depeg was blamed by many, Haseeb from Dragonfly argued that it wasn't technically a depeg. But traders obviously weren't looking for a semantic argument after being liquidated. But despite all of this carnage across the markets, many argued that Solana showed resilience by handling record transaction volume under extreme demand. Kyle Samani summarized the difference between how Ethereum and Solana performed by stating that transaction fees on Solana remained just a fraction of a penny, while Ethereum's median transaction fee was as high as $100. But as you might imagine, not everyone agrees with these takes, and a slew of negative comments followed about the failed transaction count on Solana and traders failing to close their positions during the onslaught. Now, unfortunately, all of this creates a massive problem for crypto, which already has a perception problem. If you want to learn more about that particular issue, you can check out our recent video covering it. But the reality is that most crypto-adjacent traders now have even more reason to call the entire crypto industry a scam. And one thing that really doesn't help is this backpack PR crisis, where traders who got liquidated on backpack claimed that they went to deposit more funds to long the bottom, only to find out that their deposits had been taken to cover the bad debt. Now, this led to a 2-day-long PR nightmare for Backpack founder Armani Ferrante. It is worth noting that the Backpack CEO has claimed this was fake news. But in reality, Backpack's liquidation engine probably didn't work as intended, leading some users to have bad debt. So what really caused all of this? Now, we've seen that there's a whole host of conspiracy theories out there. So here's a really quick rundown of the reactions and the theories around how it all went down and how it got so dramatic. In true crypto fashion, we exploded with theories about stablecoins depegging, crypto firms getting completely blown out, the Chinese government involvement, sophisticated attack on centralized exchanges, you name it. But the most popular conspiracies are that the crash was orchestrated either by CZ and the Binance cabal or by the White House itself to pump the Trump family bags. Here's what actually happened. Diogenes points out that this all started with China's announcement about controlling rare earth mineral exports. The very next day, newly opened hyperliquid accounts deposited $80 million, then a series of $10 million clips to short BTC and ETH with large sizes. This pushed BTC down from 121k to 117k. This user points out that the very same whale is still holding a $90 million Bitcoin short right now. So if this was just lucky timing, he would have closed after making $190 million of profit. But he's holding because he knows more pain is coming. He says this is insider information, not skill. But here's where things get even stickier. That insider was opening trades until just a minute before Trump's announcement.
In fact, this person continues to short Bitcoin all the way up till 2049-23 GMT. Why is that significant, ladies and gentlemen? It's because 2049 is the last short he places, okay? 2050 GMT. A minute later, 1 minute later, Trump announces they're considering an 100% tariff on China, which of course tanks the market. And this person makes literally $190 million in 24 hours. Meaning the guy was placing shorts up to 1 minute before Trump announces this big, huge 100% tariffs.
And we'll get back to insider trading claims in a second. But Miles Deutscher argues that this crash was the perfect storm because the risk factor in the market had grown a lot bigger than it seemed on the surface. When you combine that with the fact that many altcoin valuations are fugazi, it leads to a massive wipeout. Jordi Alexander likened it to the liquidation cascade of May 2021, where after months of a run-up and low volatility, people started taking more and more risks as they chased more and more money with too much FOMO from retail, who was obviously using more and more leverage. And while many pointed to stablecoins like USDE depegging as the core root of the cascading liquidations, Elon Trades claims flat out that this was Binance's design flaw, timed of course with macro panic from Trump's tariffs for cover. Now let's zoom out for a second, because this week's crypto crash is a great reminder that prices were inflated and crashed across all risk assets, not just crypto, but Wall Street too.
Stocks took a nosedive on Friday after President Trump threatened a big tariff hike on China. Until then, Wall Street had been at record highs for months.
Here's Andrew Ross-Sorkin comparing today's markets with the 1929 global financial meltdown.
This is either a gold rush or a sugar rush. And we probably won't know for a couple of years which one it is.
Loopify echoes this sentiment about a genuine top signal, and he argues that unless we see a big pump by the end of year that takes us above those October 10 liquidation levels, that it most certainly will be the end. So is the bull run over? Well, ironically, no. Detractors can make their arguments about Solana's failed transactions or even argue that retail has no liquidity left, but here's the reality. This flush might have just fixed the cycle leverage that's been the invisible hand throttling altcoins this entire cycle. Elon Trades also argues that what happened this week was a macro shock from tariffs combined with Binance's pricing glitch, triggering a cascade of forced selling. Now that it's over, the system has flushed out that excess. He continues that historically, this kind of reset looks a lot like May 2021 or post-FTX 2022, both followed by short 1 to 4 week relief rallies, then a period of quiet consolidation before the next move higher. So short term, this is the healthiest setup alts have had all year. Meanwhile, this account says that we're not even close to the top, although we can certainly go lower in the immediate future. One of CT's most famous pundits, Kobe, also says that we will recover, and he adds that now is the time to focus on high conviction plays, and that he wouldn't let a leverage blow-up dictate his long-term views. The future is bright, good things to come, and patience is rewarded. But to help us better answer the question of whether or not the bull run is over for retail, here's Bitwise CIO Matt Hogan on what Q4 might actually look like for the entire crypto industry.
I'm not sure it's the base case. I think we rally hard in Q4. I think the setup is absolutely incredible. You have Wall Street rallying around the debasement trade as the most popular trade of the year. I think people are going to pile into that so they can show their clients at the end of the year that yes, they saw this coming. They were in Bitcoin, they were in gold. So I think we're going to see strong flows there. I think you're seeing an acceleration of ETF flows. When we combine those two things, I think the price goes up substantially.
Hogan's takeaway is simple. While the market may wobble in the short term, crypto remains largely insulated from this kind of geopolitical noise, and it might actually serve as a hedge against it, leading many investors to maintain their bullish bias for Q4 of this year. Now, of course, the argument that retail traders are out of dry powder after being liquidated in droves is a valid one. But it's also worth remembering that this was largely an overreaction to Trump's dramatic tweet about tariffs on China, which he later backpedaled on. So it's more of a leverage reset than a global financial meltdown or a full-blown US-China trade war. A quick reminder here that none of the information in this video or on Solana Floor generally is financial advice, investment advice, or any type of advice. It is solely for informational and educational purposes. With that, I want to thank you for tuning into Solana Floor, and I'll see you next time for more of the very latest.